In today's episode, I'll talk about two interesting stories. In the first story of the day, I'll talk about a new front-running case which SEBI has recently uncovered. And in the second story of the day, I'll talk about what exactly is happening in the banking industry of India with respect to unsecured loans and bank deposits. Welcome to the Daily Brief Show by Zerodha, where our aim is to cut through the noise and simplify the biggest news and stories in the financial markets in a way that is easy to understand, yet one level deeper as compared to your traditional news channels. I'm your host Anurag Bansal, and today is Wednesday, the 29th of January. Before we get started, here is a very quick announcement. See, every evening after the markets close, we put out a no spam aftermarket report which captures a broad sense of whatever has happened in the markets on that day. Now, I'm pretty sure it'll be very useful for you if you're a trader, an investor, or anyone else interested in the markets at large. So do check it out from the link in the description below. Now on to today's stories. In the first story, I'll talk about a very large front-running case which SEBI, which is India's securities regulator, has recently uncovered. But before I get into the details of this, for the sake of those people who are new to the markets, let's first get a very clear idea of what front-running exactly is. See, front-running in very simple terms means using secretive information about a big client's upcoming stock or derivatives trade and then trading those same securities before the client does. Basically, by entering early, these traders try to profit when the big client's trade causes the prices to move significantly. And in this particular case that I'm going to be talking about today, SEBI believes that there was a very carefully planned operation which involved 8 individuals who took advantage of one large client called Gagandeep Consultancy Private Limited. Now, the people at the center of the scheme include 2 brothers, Ashish and Amit Kothari, and along with them are their wives Neha and Heetal. Now, both brothers ran a small stockbroking business under Arihant Capital Markets, but the real advantage they had came from their inside man, a dealer named Nirav Sapani who worked at Anvil Share and Stockbroking. Now, Nirav was in a pretty unique position because he was the one who was handling orders for Gagandeep Consultancy. Even more intriguing is that he was related to both the Kothari family and to the people who were placing orders at Gagandeep, and this made it almost seem like a family-driven plot. Now, the way they made money involved using their knowledge of when Gagandeep planned to buy or sell large quantities of shares or derivatives. Now, Nirav, while at his dealing desk at Anvil, would receive Gagandeep's trading instructions. But instead of simply placing Gagandeep's trade in the market, he would phone the Kothari brothers using Anvil's office landline. In Gujarati, Nirav would reveal which stock or derivative was about to be traded, the amount of the trade, and the prices for different parts of the transaction. Now, with this information, Ashish and Amit would immediately place their own orders so that they could get in at the best possible price. And in return, they expected to benefit once Gagandeep's big order pushed the market in a certain direction. Now, they even spread these trades across multiple accounts in their names, their wives' names, and their HUF or the Hindu Undivided Family account in order to hide this pattern. And over 5 long years from 2018 to 2023, they earned illegal profits amounting to roughly 4.82 crore rupees. And most of it came from derivatives, which can be highly profitable if you pretty much know when and how the market will move. But they still needed to share some of these profits with Nirav, who's a dealer on the inside. They came up with a clever method of transferring money to Nirav through the bank account of their office peon, who's a man named Krishna Kadam. Now, on paper, Krishna only earned about 10,000 rupees a month, but still his account was actually being used to send millions of rupees. SEBI's records show that 1.36 crore rupees passed from Kotharis to Nirav through Krishna's account, with some additional funds also sent to Nirav's driver and regular transfers made to Nirav's wife, Jugmi. And these details probably now give you an idea of how much money was quietly changing hands. But what very interestingly and funnily stands out here is how less of an effort these people made in order to conceal their communications. See, SEBI has reviewed recordings which show hundreds of phone calls from Nirav to the Kotharis, usually during market hours, using the same 2 landline numbers at his workplace. During these calls, Nirav would pass along precise instructions, telling them exactly which shares to buy and sell, and also in what quantities and what prices. Now, the match between Nirav's instructions and the trade that hit the market was extremely high, and it reached to 100% in some instances, which actually shows that there was no coincidence. And now when SEBI has finally discovered what is going on, they have very quickly frozen assets worth 12.58 crore rupees belonging to all the 8 individuals involved in this case. Now I know this amount is much higher than the 4.82 crore rupees that they are believed to have made illegally, but regulators do this sometimes to make sure no money is moved or hidden during the entire investigation process. SEBI also banned these individuals from trading altogether and have told them to place their illegal gains into an escrow account and have given them 21 days to respond to the charges. In addition to this, SEBI has instructed banks and depositories to block any movement of funds or shares without direct permission. But perhaps the most important part of the story is how it exposes the potential gaps in the market's monitoring systems. For 5 whole years, these people were able to carry out their plan under everyone's noses, making thousands of suspicious calls from a supposedly regulated dealing desk and matching almost perfectly with Gagandeep's trades. This raises questions about how many such rings might be active right now and whether current rules for monitoring dealer communications are strong enough or not. So although the immediate issue is the large sum of money made illegally by these 8 people, the deeper concern is the weakness in our entire trading environment. This case is a reminder that even one high-profile front-running scheme can reveal bigger vulnerabilities. With that, let's move on to the second story of the day. Now, this story is about banking and finance and has 2 broad parts. Now, both these parts explore different aspects of the banking sector, which is important for us to understand as investors and people who track the markets. Now, the first part is in the rising stress of unsecured retail loans, and the second one is a growing challenge within the deposit side of banking. Recently, the RBI or the Reserve Bank of India highlighted concerns about rising defaults in unsecured segments, especially in microfinance. This was mentioned in RBI's Financial Stability Report published in December 2024. The report showed that loans overdue by 31 to 180 days increased from about 2.15 to 4.3% in just the first half of 24-25 financial year. It also showed that many borrowers who took multiple loans at the same time or those who had a lot of debt were more likely to miss their repayments. Now, over the last 3 years or so, the percentage of people borrowing from 4 or more lenders went up from 3.6% to 5.8%. This means more people are taking on loans from different places, making it tougher for them to pay everyone back on time. Now, recently, quarterly results from banks and NBFCs confirmed these worries as well. Many of them reported a rise in defaults and growth in microfinance loans seemed to have slowed down. One example is IDFC First Bank. See, overall, it did not do too badly in the quarter, but its microfinance loans were a very weak spot. A large portion of its bad loans, which are also called slippages, came from microfinance itself. From April to December, the bank had set aside about 8% of its total microfinance loans as a provision for potential losses compared to just 1.7% for its other loan categories. Now, provisions, for your reference, is the money that some banks keep aside expecting some loans to go bad. Now, in the same period, the bank's non-performing assets or NPAs in microfinance jumped from 2.5% last quarter to 4.5% this quarter. And it's not just IDFC, Kotak Mahindra Bank also felt some amount of stress in its microfinance portfolio. Although it reduced its share of retail microcredit loans by a bit and has been running microfinance businesses like BSS Microfinance for many years now, the exact numbers for these subsidiaries are not yet publicly clear. Management has hinted that the microfinance section might be under some strain, so Kotak has shifted its focus now to safer kind of loans like home loans and loans to businesses. By growing in areas that are less risky than microfinance, Kotak is basically trying to control any potential losses and keep its profitability relatively more steady. Now, ICICI Bank seems to be doing fairly well in comparison. It is still experiencing growth and its bad loans remain low. In fact, its overall gross NPA ratio has gone down from 2.3% a year ago to around 1.96% this quarter. The portion of its bad loans in its retail and rural segments has also increased a little, but it is still below the bank's average. This suggests that the retail side is not quite dragging ICICI Bank's performance down, at least as of now. Now, HDFC Bank, which went through a big reverse merger a couple of years ago, is also now seeing a slight uptick in its NPAs. And because HDFC Bank is so large, even a small change in its NPAs will be worth watching very closely. Its category, which is known as Commercial and Rural Banking or CRB, which focuses on smaller businesses and marginal farmers, has seen NPAs go up from 1.8% to 2.0% in just a few months. This is another hint that the stress in the microfinance sector could be affecting big banks as well. But outside the traditional banking sector, there is Spandana Spurti, which is a lender focused only on microfinance. Its recent numbers showed a big drop in the new loans and a sharp jump in bad loans. Its net performing assets rose from 1.61% to around 4.85%, which indicates that more customers are now struggling to repay. And while all of this covers the rising stress on the lending side, there is one more issue that banks are facing right now, which is deposits. Now, the RBI's deputy governor recently spoke about some trends which could cause problems in the future. See, banks today depend on deposits in order to make loans, but deposits are often short term while the loans that they give out can last much longer. And this can sometimes lead to a mismatch in timing if too many depositors want their money back all at once. As of the 2024 financial year, Indian banks had deposits worth 217 lakh crore rupees, which made up 77% of all of their liabilities. Now, deposits mainly come in two forms. The first one is CASA deposits or current account and savings account deposits. These are typically from regular folks and small businesses who leave their money in savings or current accounts and do not quite expect very high interest. CASA deposits are generally considered more stable and cost-effective for banks. Then there are term deposits, which offer much higher interest rates and are more likely to come from big institutional clients who are looking for better returns. Now, lately, the share of term deposits has been growing quite a bit, while CASA deposits have been shrinking a fair bit. And this shift can be expensive for banks because they have to now pay more interest in order to keep these term deposits. And if banks pay more to get deposits, they usually have to charge higher interest on loans in order to maintain their own margins. Kotak Mahindra Bank, which used to be known for having a lot of CASA deposits, has seen its CASA ratio fall, and that puts pressure on the bank's net interest margin or NIM. Now, net interest margin, for your reference, is basically the difference between the interest a bank earns on loans and the interest that it pays on deposits. If the bank has to pay out more interest in order to attract depositors, its margin shrinks unless it hikes the interest rate that it charges on loans. Now, putting these two parts of the story together, it is very clear that banks are now trying to manage multiple challenges all at once. They are seeing more and more defaults in unsecured loans, especially in microfinance, and they are also watching their deposit mix move away from cheaper CASA funds to more costlier term deposits. That can eventually start eating into their profitability, and as a result, banks are now becoming more and more careful about lending, and they're focusing on safer areas like home loans or corporate loans where they have some collateral to fall back on. They are also spending time and effort to attract more CASA deposits in order to keep their funding costs low. With that, let's move on to the last section of the day and talk about the quick news tidbits. First, Tata Steel reported a 36.37% year-on-year decline in consolidated net profit to 326.64 crore rupees. This was driven by subdued global steel prices and challenges in international operations. Second, GSW Group has announced its entry into copper mining by securing a 2,600 crore mine operator and developer or MDO contract for 2 copper blocks in Jharkhand. With an ore capacity of 3 million tons per annum or MTPA, the mines are expected to be operational by the second half of FY 2027. Third and the final one for the day, the Reserve Bank of India has announced a liquidity injection of 1.5 lakh crore rupees to address a record deficit of 3 lakh crore rupees in the Indian banking system. This includes 60,000 crores through open market operations or OMOs in 3 tranches, a 50,000 crore variable rate repo VRR auction on February 7th, and a $5 billion rupee swap auction on 31st January. These measures are broadly aimed at stabilizing the rupee, which is currently under pressure due to foreign portfolio outflows and support credit demand. That's all the news and stories I have for you today. I hope you enjoyed the show and maybe learned something new from it today. This is your host Anurag Bansal signing off. Take care and I'll see you in the next episode. Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.